Top of the morning, everybody. I got a funny purple row paisley tie. Look, the paisleys are kind of in a row. Never seen that. Very bizarre. Before we get into it, quick disclaimer. Reminder everybody, this is for entertainment and educational purposes only. And today what I spotted, I went and looked at the graph, which I look at every day, and noticed the Good1 portfolio is diving. So way out of what was expected. We're going to go in and look at the rules and then make some adjustments as needed. Let's get into it. Captain Ron, July 17th, and what I noticed was the Good1 here is diving out, way out of from where all the rest of them are. The other thing I noticed was the benchmark, which is our S&P 500 bond fund. This one is the leader. The pharma, which was bouncing up here, is now dropped below it. Everything else is below it. So this is not statistically significant yet, but it is an interesting observation that the best portfolio that we could have bought 6 months ago is just the S&P. Crazy, huh? But that is the way it works. S&P is a good portfolio. The rules of this portfolio: monitor when it goes crazy, sell some of it, no classic rebalance, reinvest as needed, probably very little anticipated. When any one stock drops 30% or so, consider selling it. And this is what has happened. If we go look at these, all these ones in red are below 30 or at 30. This was 40%, 36%. What I'm going to do is sell all of these in red, get rid of those, and then go look at, because this is a diversified portfolio, let's go look at the sectors, sector diversification, see if we can come up with some good alternatives. Here's a quick recap of what this is. And remember, we used FinViz to find these. So I'll use FinViz to find the replacements. But once I pulled those equities out, I can see right away that I've got a hole in financial services is low, nothing in real estate, technology is low compared to the S&P, and then nothing in utilities. The criteria had to loosen up a little bit to find a utility one. Then I iterated with the Efficient Frontier, went back and forth with FinViz, and I was able to pick out these 4 new candidates for our portfolio, and these should bring that sector diversification back in line after I gotten rid of those 7. So I took out 7, added 4. Here is the 7 in red that came out. See all the zeros? They're now out. Here's the 4 that came in. I took the funds from the 7, divided it equally, around a little over $2,000, and putting it in the new 4. So the new portfolio looks something like this. It's a much happier looking gain over here. I want to see more green than yellow, and worst case is half and half. I like this much better so far. Let's keep an eye on it. It's only 3 weeks in, 6:30, 7:17. So that happened pretty fast. But again, these are little tiny companies, very volatile. They just have some money, have some cash reserves. The new portfolio, see, it looks much better. The financial, real estate, technology came up a bit. And then I do have some utilities now. I bought 1 utility stock. All right, so we're going to continue to monitor this just as needed. Other than that, it'll just be buy and hold. We're going to watch it. Hopefully this set will last more than 3 weeks. That was sort of surprising how fast that went south, but that's why we keep an eye on it, watch it, and don't be afraid to change them out when they start to crater. Reminder everybody, the portfolio matters. Top of the morning, wishing everybody a chew, and time to retire this funny purple paisley, lined up paisley tie, lined up. Huh, who thought that was a good idea? I don't know. Oh, Anders of Anchorage did. All right.